What is the first thing that comes to your mind when you think about stock trading? The casino? Intelligent people? The market crash of 2008? A lot of people will still be influenced by what happened in 2008. It forever ruined the public trust to financial institutions. But how risky is it actually to be a part of the stock market? Hello guys, and welcome back to the channel. Please make sure, if you haven't already, to subscribe to the channel. And while you're on it, why not just give the video a like as well? In today's video, we'll be talking about how risky it is to invest in the stock market. The amount of Americans who own a stock was at 62% before the financial crisis, and it dropped afterwards and is still only at 55%. A pretty decent number, but what makes the remaining 45% stay away from the stock market? When I'm talking with people, a lot of them are afraid that their money will just disappear if they put them into the stock market. And yeah, that might be a risk, but how big is that risk actually? What if I told you that if you invested $1,000 in the stock market right before the financial crisis in 2008, when all stocks were on the all-time high at that point, you would actually today have more than doubled that money and now own about $2,100. So this was investing just before a crash. So what makes investing risky then? I have divided it into three main points, which I'll be going through now. The first one is your time frame. Okay, so when we're talking about risk, we all know that investing comes with a risk, and you're never 100% sure that you're going to make money. Or what? Well, no, you're never 100%. I don't want to promise you that, but let's take a walk down history lane and see how impactful your time frame can be when it comes to investing. Just take a look at this graph. It shows the historical probability of loss decreases by holding equity longer. It ranges from 1 to 15 years and shows your chance in percentage of selling your investment with a loss. This means that being in the market for less than 1 year is not that much better than playing the roulette. Besides, you probably won't lose all of your money in the stock market, and this is also something to keep in mind. This graph doesn't show you whether you're going to lose all of your money or double your money, just how low your chances of a potential loss are. But already after 1 year, you will lower your chance of losing money to only about 25%. After 6 years, you cross the 10% line, meaning that you have a 90% chance of making money by being in the market for 6 or more years. This is a pretty great chance of making money and a pretty slim chance of losing your money. When we then have a look at the graph towards the end, we can see that by being in the stock market for 14 years, there's a 0% chance of losing your money. What this means is that no matter at what point you invested your money in the period that these numbers are from, which is from 1971 to 2020, you would, after 14 years, no matter what, come out on top with a profit. So this doesn't matter if it was just before the crash in 87 or just before the crash in 2008. This is why so many people are talking about time in the market instead of timing the market. The one of them is easy and just take patience, where the other one is nearly impossible and can make you miss out of some great profits. So keep this graph in mind when you're considering investing your money. If you need your money within a year, they might be better off on your bank account. But if you don't need your money within the next 5 or more years, the stock market could be a great place to put your money. Therefore, your time frame is the number one indicator on how risky stock trading actually is. The second point is your investment strategy. When you start out investing, you will need to make an investment strategy. This will both lower your risk and make sure that you'll sleep well at night. Having a strategy can't just be a short list of how you're going to handle certain situations. Are you going to set a stop loss when you see a 10% drop in your stocks? Or will you keep your portfolio just as it is right now, no matter how much your stocks are dropping, simply because you're in for the long run? No matter what, you'll need to figure out what your strategy is and write it down. This will make it easier for you when these things will happen in the future, because being in the market, these things will happen. Then you also have to determine what percentage something is allowed to have in your portfolio. What I mean with this is that you have to decide both how big of a percentage your portfolio should be in stocks and how much in, for example, bonds. Then when you have figured this out, you'll need to set a percentage of how much each stock is allowed to take up of your portfolio. I myself, for an example, have a rule that I don't want one single stock to fill any more than max 10% of my portfolio, and preferably no more than 5%. But then when it rises, I won't have to sell it straight away if it should go up to the 10%. And if one stock should go way up, I will sell some of it just to keep it below that 10% mark, and then reinvest the money into a stock that I believe in but might have dropped below the 5% mark. This will make sure that I'll never lose more than 5% of my entire portfolio just cause of the losses in one single stock. The third point is diversifying. Yeah, you probably guessed it. Here it is again. When we're looking at the graph from our first point, this is of course not based on a single stock, but based on the entire worldwide stock market. So this doesn't mean that you can just find some random penny stock, put your fortune into it, just wait 14 years and come out with a profit. You might hit the next megatrend, but this is one of the most risky investments you can make. In order to follow these numbers on the graph, you will need to diversify. And the more you diversify, the less risky investing is. You don't have to put all your eggs into one basket, but find 50 baskets and split your eggs between them, and preferably 50 completely different baskets. Maybe also made in a lot of different countries. What are you talking about? Well, yeah, sorry. Find many stocks, maybe 50 different, from different sectors and different countries. This will lower your risk, and you'll never be dependable on one specific stock, one sector, or the economy of one specific country. Okay, just briefly to catch up. Timeframe is key when it comes to investing, both when it comes to compound interest, but especially also when it comes to lowering your risk. As shown, you would previously not have been able to lose your money if you had just been in the market for 14 years, which is a lot, but remember, 5 to 6 years in the market gives you a 90% chance of gaining money, meaning you would have had to enter the market at one of the all-time highs and probably just before a market crash in order not to make money. Then, setting up a strategy for yourself will also play a big role in order to lower your risk. You won't panic when the market is going crazy. It will help you sleep at night, even if you see some massive drops, because you know what to do. And then lastly, remember to diversify. Don't be dependable on a small part of the market. This can be where the money is at, but it is a really risky way of investing. So remember, put your eggs into a lot of completely different baskets. This was Investing Explained, explaining how risky investing actually is. If you should have any questions remaining, just let me know in the comment section. And if you made it this far, please make sure to smash that like button. And if you haven't already, please also subscribe to the channel and press that bell. Thank you guys for watching. I'll see you next time.